Okay, everybody, it's that time. It is Thursday, 3 o'clock Pacific Standard, and we are jumping into our live right now. This is Kelly Cook with the Everything Phoenix YouTube channel, where we discuss everything Phoenix. You guys guessed it. So today we're going to jump right in. But first, if you wouldn't mind leaving some comments below or let us know where you're from. And if you have any questions, we'd love to answer those live right here so you get the latest and greatest news about what's going on with the housing market in Phoenix, as well as any developments and just great things happening or not around the Phoenix area. We're going to give you the truth and the truth serum, no matter what happens, guys, if it's good or it's bad, so you know how to make informed decisions, because that's what it's all about. So that being said, if you don't mind saying where you're from, that'd be great. Love to know where people are tuning in, where they're watching from, if you get a chance. Otherwise, we're going to get started right away. Okay, so today we are talking about, obviously the housing market, and the topics today specifically are some red flags. What are they? How are builders handling those the housing market right now with interest rates and inventory sitting on the market? Is it cheaper right now to buy, or is it cheaper to rent? What's the better decision there? So we're going to discuss these things and jump right in, right? So as always, I like to have some data to back up, kind of what I'm talking about, not just my opinions, of course. And we'll center all of that around the news articles that we find and the data on the housing market. So we're going to jump right in here, and we're going to first kick off, I should say, with talking about the builders. Okay, the builders. What are they doing? Are they hemorrhaging? How are they handling the high rise of interest rates and lack of typical buyer demand? So right now, you can see that article here from the Phoenix Business Journal, which we love to subscribe to and get most of our news from, because it is very localized and they know what they're talking about. They got some smart people on that staff. So it's officially a buyer's market. Here's how the home building industry is handling it. I saw that and go, well, this is interesting, right? So let's check this out. There's a couple things that are kind of interesting. The tides have turned. And now for most of the areas in the valley, it is a buyer's market. Now, but guys, we covered this before. Remember, in certain areas, it's not so much a buyer's market than it is in other areas, right? There are other sections of the market right now, like Scottsdale, for example. It's still by definition a seller's market, by data definition, right? Paradise Valley, Fountain Hills. So these are the areas where it's a little more affluent, and it's not in the outskirts of the valley or where the entertainment is and the dining. So no surprise there, right? So hey, we have Abby from Des Moines, Iowa. Hello, Des Moines. My dad's from Des Moines, Iowa. I like Des Moines, Iowa. I love it. It's a great place. A lot of insurance business there, but a great all-American city. All right, so going back over here to the article, let's talk about what the builders are doing. So I highlighted this earlier. I was reading this. Most builders are offering interest rate buy downs and money towards closing costs. Now, what's interesting, we're going to see on this article, is that they can do kind of what they want if you are financing through their mortgage company. So they can offer some really sweet deals, but so can regular lenders as well, if you're able to, let's say, potentially get the seller to pay for a interest rate buy down. So what is that? Let's pause for a second to understand something, guys, because this is going to be out there in the news if you haven't heard about it right now. This is part of the education of if you're going to buy a house. Right now, it is better or cheaper in most cases for a seller to offer a concession on the sale of the house to pay, essentially let you finance a rate temporarily that is lower, so therefore your monthly payment is lower. Okay, because we talked about this before. Did you know that general rule of thumb is for every 1% of an interest rate that increases or decreases, but in this case, increasing interest rates, if it goes up 1%, right, that approximately erodes the buyer's purchasing power on a monthly payment basis by 10%. So in theory, if all the buyers that were looking at your house, you're looking to sell, are financing and no one's paying cash, in theory, you can make the argument that when the feds or whatnot, mortgage rates actually go up a full percentage point, then kind of the value of your property is decreasing by a somewhat similar number. Again, that's only in a vacuum, right? But there are a lot of cash buyers in Phoenix, and so that's not necessarily the case everywhere. But that's something to be considerate of, or be aware of, I should say, when you're looking to potentially make the move or ask the question, should I buy right now or not? But you have right now, so let's go back, 2-1 buy down. So you have a one rate buy down, you have a 2-1, you have a 3-2-1 buy down now. That's actually a newer product that most lenders are offering. So what that does is, let's say effectively you are pre-approved at a 7% rate today. Okay. If you do that, but you're able to get a buy down, whether the seller pays for it or you do, but in this case, because buyers have leverage, you should be getting the sellers to pay for this. That's what we're doing for our clients. Then essentially you are getting that 7% to be a 6% rate for 1 year. Okay. If it's a 2-1 buy down, you're getting that 7% rate to be a 5% rate for year 1, and then back to 6% for year 2, and then back to your full 7% in year 3. Now, if it's a 3-2-1, I feel like I'm like, NASA, right? Ready to launch a rocket or something. But if you're doing a 3-2-1 buy down, then it's more expensive, of course, but you get a 4% rate for that first year, and then 5, 6, and then back to the 7. And the whole concept or thought here is that you will be able to refinance because rates will drop down in 1 year or 2 years or 3 years, whatever one you do. And you'll be able to refinance down to the rate that's lower before you have to actually pay the full boat of the 7% monthly payment. So it's an interesting concept, guys, but there's leverage out there, and they can be expensive to buy down, but there's leverage out there with the sellers. And if sellers want to sell their house, this is something you should be looking at doing and educate your buyers or anyone who's looking to buy on this type of thing. Okay. So thought that was interesting. And you have other incentives here too, guys. Common incentives include, rate buy downs, long-term rate locks, money to be applied toward closing costs, et cetera, maybe upgrade credits. So you have some leverage right now. So if you're thinking about buying, this is the time to do it, guys. And side note, I was just at we're going to look at the Crawford report here in a second. Crawford report is the leading housing economist in the state of Arizona. And Tina, who runs it, who's brilliant, by the way, it's all data-driven, like 100%. No opinions. Okay, maybe like, a little here and there, but all data-driven, right? But she's awesome. And she was saying in this presentation she was given just yesterday, guys, that right now sellers get hope in Arizona in the springtime. Really, sellers get hope in Arizona in January after the holidays, because that's kind of what everyone thinks. Why do they have hope? Now, irrespective of what the rates might be doing, they have hope because of the localized events that are happening and the activity that's happening in Phoenix. Because typically what happens is the snowbirds pile into Phoenix. If they're not here by November, they're coming in January, right? And so you have more people, more activity happening, more money flowing into the local economy. You have events. You have Barrett-Jackson Auto Auction, which is huge. You have other auto auctions. You have the Waste Management Phoenix Open, which is enormous. And you have the Super Bowl this year, guys, coming up in February 2023. You have spring training as well. And there's no threat of a baseball strike this year, so it's going to happen, right? Unless something really odd happens. And so you have all these events happen, and that gives sellers hope, consumer confidence. So if they're looking to sell and then they put their house on the market in January, you may have, even though the market could still be in the exact same position or even worse, the hope, because they may not have to sell, may allow you not to have as much leverage. So if you're looking to buy and that's something you want to accomplish, and of course, get your monthly payment as low as possible, think about doing it between now and the end of the year, because the sellers that are on the market now, may not have the eternal hope that potentially one that would have that's trying to maybe test the market, that kind of thing, in January does. So keep that in mind, guys. Okay. So as we come down here, let's see what this one builder, Taylor Morrison, they interviewed Lennar as well. But you're talking about, look at this, for limited time in certain Phoenix metro communities, Taylor Morrison is offering a 4.99% 30 fixed rate with a 5.025 APR. So it's a financial savings of up to 3%, guys. So we're talking this 3-2-1 buy down. That's essentially what Taylor Morrison, their mortgage arm, is effectively doing. Okay. So interesting, right? This will help keep their prices up, hopefully, because then, in that situation, they don't have to discount the price if the payment is affordable to the buyer. All right. So they talk about other things too, about demand. Phoenix still is very good in demand. And when you look at the Crawford report, so if I jump over here, you guys can see this, right? Let's talk about that for a second. Okay. Because if you go to the Crawford index for all areas, there's our demand right there. So our demand is at 79.7%. We are in technically a balanced market right now by data definition. Look, guys, we're at 98.8. 100 is a balanced market. Anywhere in that yellow right there. So we are in a balanced market overall. Our demand is at 79 and our supply is at 80. So our demand is actually low. Our supply is low as well, below 100. So in this situation, that constitutes basically, a balanced market. So going back here, they still feel, the buyers, that they're seeing a good amount of demand. Now, remember, these guys are national, right? These are national builders. So, according to other places across the country, Phoenix has good demand compared to other markets, right? So this is good. Lennar is saying the same thing. All right. So then they're giving examples of these are pre-pandemic inventory levels. So it's nothing that they're that freaked out about right now, because it's nothing close to what it was, obviously, from data standpoint in 2007, 8, 9. And so they go on to talk about that. So, anyways, of course, he's making the pitch here, right? How much equity are you building when you're renting? Well, the answer is zero. It's 100% interest. And so, obviously, being in the business of building homes, they want to sell them, and therefore they're making the pitch that you may want to think about buying. Now, okay, and this is going to segue perfectly, guys. It doesn't always happen like this, but this time I got lucky, right? If you go out and rent, that's not going to happen. He said rental rates are not cheap. That's true. They are not cheap. But let's segue into that for a second, because what are they? What are they in Phoenix? I'm glad you asked. I'm glad you add that question in the comment. So here we go. Median lease price per quarter. This is straight from the Cronfer report, guys. And you have an idea now of, look at this, for the first time in a long time. In fact, this graph goes back to 2015. Guys, the median lease price in Phoenix in 2015. $1,160. Guys, that is El Cheapo. That was undervalued big time. I mean, for a long time, it was undervalued compared to any major market across the country. That was undervalued for rent. I mean, it just is. It's crazy to think it was that cheap, but it was. I mean, here's the data. And so now you look at 2023 or 22, I should say. We had this huge run up. Obviously, there's a pandemic area right in here, right? And then this is Q2 2020, and they took off. Boom. I mean, skyrocketed, right? As real estate values did too. But now you see this, guys. Right now, the average median price today in Phoenix has actually curtailed and went down the opposite way. It's at $2,125 a month for the average, or excuse me, the median price. So for the average home, let's say, or place to live in the Phoenix area. That's interesting. And I love the fact they exclude vacation rentals, because that skews everything. So this is a very accurate number, guys. But it's going the wrong direction. We'll see what happens in quarter 4. Now, if you look at price per square foot, this is interesting as well. Price per square foot. So those of you guys want to, calculate where maybe you should be for negotiating purposes, if you're looking at renting a house, the monthly average lease price on a price per square foot basis is $1.36. And you can see the different numbers. But look back here, guys. In 2015, it was 70 cents a foot, 73 cents a foot. That is incredible. Absolutely incredible. So you can see, and this entire Maricopa, or this is the greater Phoenix area, served by the local multiple listing service, which is pretty much, like I said, the entire area of all Phoenix, all suburbs, etc. Now, by comparison, should I rent or should I buy? Now, I'm going to answer that, give you my opinion in a second here, but let's present the data first. So the average price now for the lease property is $2,125 a month. Well, what's the average sales price right now? Okay, here we go. Here's a chart on the Cronfer report again. It gives data. Let's go to today. There's our numbers. Okay, 2022, $554,000. Let's call it $555 because that's really close. So $555,000 here in 2022 in October. Now, last year it was $472, and of course, this is after the pandemic, before we had our full V-shaped recovery, right? You're at $377,750. And then, of course, you can see the numbers down there. 2015, when the rental rates were $1,100 a month, you also had a average sales price of $260. So pretty crazy, right? To see the increase of appreciation over time. But what's that breakdown to a monthly payment? Because that's what it comes down to for most buyers, right? Monthly payment. That's more important than necessarily than the average price, right? What can I afford, the monthly payment? So I went over here, pull up Credit Karma here, the good old amortization calculator. Everyone loves this. So if you're still with me, guys, hope you're not falling asleep. This is interesting to me. If you put down 20% on a $555,000 home, which is the average median price, excuse me, let's go back here and get this right. The average, not median, sales price, okay? Maricopa County, greater Phoenix area. That's $111,000. So first of all, you have to have $111,000 And you can do 10% down. You can do 5% down. You can probably do 3 or 3.5% down. But if you did 20% down and the loan amount was $444,000, 30-year fixed rate, 7%, okay, which is about the going rate, give or take, all right, for right now for a good borrower, that gives you a monthly principal and interest payment only of $29.53. Now, you throw on taxes, which are pretty cheap. The tax for this property, that's $555. Shoot, it might only be, I don't know, $3,000 a year, something like that, right? So if you're at, let's call it $3,000 a year, $250 a month, that could be about right. Depends on several factors, but you guys know that property taxes in Arizona are not based off the market value of the property. They're based off the full cash value, which is about 80%, give or take, from the tax assessor's office. But if you take $29.53 and you add another $250 and say you want to do another $150 for insurance, maybe your insurance, let's do $100. That's $350, right? You go $350 plus that, you're about $3,300 a month, roughly, guys. Really rough here, okay? Don't hold me to it. But you go back to the rent price, you're at $21.25 for that same average, property. So it's interesting, right? How this is working here right now with the rental chart. So that being said, it is, for the first time in a long time, it is cheaper to currently rent than it is to buy. But you also have the issues with, not building equity, paying 100% interest, but it's just gonna be for 12 months. Okay, maybe not a bad idea. Guys, so here's my answer on this. My answer comes down to this. What's right for your current situation today? It may not be right for everyone to go in to buy a house today. Now I'm a big proponent of homeownership, obviously, right? I've seen what it's done for my family. I know the numbers. I know the net worth numbers, right? We talked about this, right? The average American that owns one home or more, but just one home, the average American's net worth is about $300,000. Conversely, the average American who rents and does not own one home, their average net worth is below $10,000. So it's a huge disparity, guys. So I've seen what it's done. And obviously you look at, price appreciation right here of homes that have sold. I mean, you don't have to be a rocket science to see that graph and go, holy cow, right? But is it going to crash like it did in 2008? And the answer across the board unequivocally is no. The fundamentals and the underlying fundamentals of the market are completely different than they were back then. So that being said, is it right for you to buy right now, or is it good to rent? Now, if you can buy, I would certainly look to do that. If you have the financial means for a down payment, if you can afford the monthly payment, that's all very important because you can get in the game. You can start building equity. And what is your exit strategy, guys? That's another question you need to ask yourself if you're going to buy or rent. What's your exit strategy? In other words, if you have a position where you work or whatever the case may be, where you don't think there's anything on the horizon that would force you or literally force you to have to move anytime in the near future, call it the next year or two, then you really probably should consider purchasing a home, even though rates are high. Prices are obviously high compared to the historical prices. If you think you might, because maybe your work is on a contract and you're here temporarily or whatever, then clearly in that case, probably better to rent. But if your exit strategy is to, for all intents and purposes, be in this house for a while, then I would seriously consider purchasing a property and then using the leverage you have right now in the marketplace against the seller to be able to get a 2-1 buy down, a 3-2-1 buy down, or just a rate buy down on your mortgage to make that payment very, very affordable on a monthly basis until rates come down. Now, obviously, rates could stay high forever, right? It could happen, but it probably won't because we know the cycle and it always goes up and down. And obviously, the smart money, mortgage-backed security, people who follow that, guys like Barry Habib and the interest rate guy, and all these people that are very smart people, economists, they do feel that and think that and believe that the rates are going to come down sometime in 2023. And most of them are saying in the low fives, if not to the high fours at some point next year, because the Fed's going to have to do that to kickstart the economy that they're purposely stalling right now to try to curb inflation. Okay. So let's go back to a couple Now, this is kind of interesting. Let's go here. Let's see if we can't get this article to load here, because this article right here, guys, is about, and hopefully it'll come up here in a second. This article right here is about the single family market, rental market rates. Okay. So let's see, we got a comment here. I'll pause here for a second. Abby is asking, can I still refinance in a year if I take a buy down option? The answer is yes, you can. Certainly check with your lender to make sure they don't have any funky going on. If it's a small bank that maybe has their own underwriting, because they're, keeping the loan on their books or whatever, check with that, certainly. But generally speaking, yes, you can. So it's a great option if you're looking to buy right now. Okay, so thanks for that question. That's a very good one to ask. So speaking of rental rates, let's go back here. This article was how much the single family rental market is cooling in Metro Phoenix. Okay, cool. We just talked about that. We saw the data, but let's go here and see what CoreLogic has to say about it. All right. And I went ahead and did this here and said, looking at 45 markets she tracks across the nation, there isn't a single market that is showing negative growth in rental rates. Rates continue to rise in all those markets. Now, she's taking, obviously, year over year, right? So the rates are much higher than were last year at this time, rental rates, okay? Although they're starting to turn, right, as we just saw on the graph. So overall, rates are still high when it comes to renting. But if your option is to just go in with a 7% rate at the median, or the average sales price in Maricopa County, for example, maybe renting, even though they're high, as this article is saying, is still the better thing to do. Okay, but a lot going on behind the scenes. She talks about. All right, so there's a lot of data with the rentals, guys. This is very important to understand. They aren't putting the properties on MLS, and so if it's not on the MLS, it's hard to track. They put it on rentals.com or maybe Zillow or these other consumer portal websites, Craigslist, whatever. Right? By the way, do people still use Craigslist? I don't know, but they might. Right. And if they do, or maybe they put just a sign in the front yard, it says for rent, one of those red signs, right? And they get, one person to call every 7 weeks or something. But anyways, that being said, we don't know all the data because not everyone kind of aggregates it in one spot. But they go on to say that the rental market is cooling off in Metro Phoenix. It's not too much. It's still pretty hot. And it is, guys. Like, for example, we just helped a client rent a property in Troon, and it's a luxury property. And I just rented one of my own personal properties, and I had multiple applications on it, right? And so it wasn't like it sat there for 2 months and there's crickets and no one, wanted to come around to rent it. So there were multiple showings, or multiple people who wanted to submit an application, pay the credit fee, all that stuff, right? So it's cooling down a bit. I think this is a great way to put it right here at the end. But cooling down from what? That's what you're basically measuring it against. It's cooling down from insanity. Now it's just a hot market. I don't know if I agree that it's a hot market on the rental side, but it's a very robust one still. I would say that. Now, this is interesting too. So here we go. Migration magnets. 3 migration patterns that will shape the post-pandemic era for really across the country is what this article is talking about, but this is specifically to Phoenix, right? This is interesting. So there's 3 things. Let's go to the first one. The Sun Belt is still soaring, but so are ski towns, right? So the Sun Belt, guys, Phoenix, Texas, Florida, they're all top the list for population influx as opposed to outflux, all right? 19 of the top 20 counties for net migration were in the Sun Belt. Guys, that is crazy, all right? Doesn't surprise anybody, but we all kind of know that's where the population's going, but this is backing it up right here. The donut effect. This is interesting. This is kind of interesting. So it talks about several Sunbelt metros that have posted significant population growth over the past decade show a clear pattern: weak or even negative net migration in the largest county, accompanied by strong growth in neighboring counties. So you're seeing this donut occur, right, where the urban area is being carved out. People are kind of scattering to the suburbs, if you will, right, when they're coming to these new towns. So that's interesting. I think that's cyclical too, guys, and that will bounce back, and people will come back in the city here eventually and do that kind of thing. My prediction is because it's always cyclical, right? But then here, the trend is always taking shape before pandemic as millennials migrated to the suburbs. But COVID-19 and the rise of remote work sped up the trend, right? All right, number 3, heavy losses for the heavy hitters, but with a catch. So the big cities, New York City, San Francisco, Chicago, all posted negative net migration totals by wide margins. So it wasn't even close, accounting for billions of dollars of income on the move. Phoenix is a big benefactor of that, and that's why you see this. That's why you've seen this, especially the last, look at the gap that was, right, before the pandemic, from these 5 years right here. and then the gap that is between the last, just 2 years because of the post-pandemic, right? Pretty crazy. So that is spot on, and we're a big benefactor of that. So this is interesting. Who's moving to and from what in the country? So I just pulled up Maricopa County a couple times here. So these are migration maps, guys. It's pretty cool. They post this here. You can see different counties like this is La Paz. Obviously, the greater Phoenix area is all Maricopa County except for a little sliver that's Pinal County. Let's go Maricopa County. What they're saying here is this: that Pinal County has the most growth into Maricopa County. Now, guys, that's going to be a little off, just because Pinal County, you cross the street, you're in Pinal County, right? And it's all still a major metroplex or suburb. So that's not as accurate. But here you go. The number one county, Los Angeles County, right here. Boom. And there were 44,367 total tax filers that moved into Maricopa County from LA County. And they had an average, here we go, a total adjusted gross income of $346,000. So now you look at this and you go, where is all the money that's coming? Now, Pima County, that's Tucson. Okay. People come up from Tucson quite a bit. It's a bigger city in Phoenix, more opportunity, that kind of thing, more jobs, tech jobs, higher paying jobs, whatever it may be. San Diego County. This is interesting. Only 213, 321. So that tells you maybe a lot of the wealth in San Diego is staying in San Diego because they're on the beach and they have an ocean view. I don't know, right? But that's interesting. Orange County, 223. So look at the difference between LA County right here, 346, and Orange and San Diego County. So that's interesting, I think. Cook County is Chicago, and that's $216,000. Riverside, California. So you see Clark County. So you start seeing some of these counties rise, and they keep coming up over and over again. A lot of these are from where? California, right? So people are still coming from California in a big number, even though it's not like it was. So these are interesting aspects. Now to wrap this up here, guys, let's get into this here. So right now we are at the Crawford Market Index, right? This is the dashboard. This is going to give you a high level overview of kind of the market in a update. Any red flags, white flags? I don't know, right? And so here you go. Crawford Index, we're in a balanced market. We covered that. Let's look at active listings. Okay. Look at that, guys. Right now, this is the one that's probably more accurate because technically, guys, what UCB stands for is under contract accepting backup offers. CCBS is contingent offers. Okay. So technically, if you're active with these two statuses, they're under contract, right? So it's not as accurate. This one's a lot more accurate right here. 20,708 listings on the market. Demand is low. Supply is still low, guys. In terms of increasing supply, it's not increasing at that high of a rate right now. So even though demand is low, we still have a balanced market because supply is still low. And so that's interesting, right? Annual change, look at this, 95%, right? Increase of active listings. Monthly change, 3% from last month of active listings of it as an increase. Last 30 days, you see a little graph right here. The other one, let's do inventory, okay? Days inventory. So right now, for a while there, guys, when the market was crazy earlier this year, we had 2 weeks inventory, 1 week inventory, 3 weeks inventory, and homes are flying off the shelf, right? Well, in this example right now, we're at 88 days, including 79. So, you're about a month and a half or whatnot for days inventory. 2 months and a half for days inventory. So that's a lot more than what we had prior to. Let's go down to expired listings. These are listings that are not selling. They are expiring because for a lot of reasons. Maybe someone just didn't want to sell anymore. Maybe it's because they had false expectations of the market, and so they couldn't sell. The price was too high, and so they just took it off the market or whatever the case may be. So in this situation, monthly change, the amount of expired listings actually went down, which is good. That means the contract ratio hopefully is a little bit more, hopefully a little bit higher. Annual change, 161%. So guys, woo! Last year at this time, what this is saying is that we basically had 0 expired listings. It makes sense because homes are just flying off the market like Thin Mints and the Girl Scouts sell them, right? I mean, they're gone as fast as they can sell them, right? So 161%, right? It's crazy. Look at that graph. So we all kind of get that, but these are just true numbers here. Days on market. This is going to be a good one here. This is important, guys, get the education out. If you're going to sell a house right now in today's market, it's not like it was just 3, 4, 6 months ago, especially. And so active listings right now are on the market 71 days. And again, no surprise that it's 52 for the ones that are selling. Why? Because they're selling. They're selling for a reason, maybe because they're really updated, they're nice, they're clean, or the price is, just right for the market. And of course, the active listings are 71 days, so not as good for them. And then a few more things we'll look at here. And by the way, if you guys want to see this stuff, we'd be happy to take screenshots, send it to you, whatever it may be. But you have, let's go under contract. What is selling? How many homes are selling, guys? Well, look at this. There are 7,100 listings under contract, guys. That is a healthy number. It's not what it was. Or it's not, on average, you're going to see maybe about 8,000 a month. And in good months, you're going to see 10 to 11, maybe. So it's not that. Let's be very clear. But for a slower market, that's a healthy number. It really is. Monthly change, negative 16%. Annual change, negative 41%. So obviously, it's down to where it was when it was crazy at maybe about 11,000 under contract listings a month. Okay. And then you look at success rate. I want to cover that for you guys real quick. So this is listing success rate. These are how many listings that go on the market actually sell, they close escrow. Okay. Well, here's your historic average. And that's where we're at this month. So 68%, approximately, right? 68% of all the properties that go on the market actually close escrow. That's pretty good. Now, obviously in the higher end markets, like, homes that are 2 million plus, typically that number is a little lower because there's just less buyers out there for, that type of a home. But typically if you're in a $400,000 price or under, $500,000 or under, that's going to be typically a lot higher because there's more buyers that can afford that type of home. But what's odd is right now in this market today, you're seeing the properties that are actually under, that $500,000 mark struggling to sell a little bit more. And that number will be coming down, I'm pretty sure, as we track that over the next several weeks, because again, interest rates basically stymie that type of buyer. They're a lot more rate sensitive, right? That makes sense. So guys, I hope this makes sense. Inflation is starting to flatline a little bit, but it's still, I shouldn't say flatline because it's still all over the place, but it's not going like this as it was earlier this year. So hopefully it starts to turn at some point and starts to curtail and come down. Again, Jerome Powell, we know what his intentions are. He has explicitly said that he is an all-out war against inflation until his goal is that it reaches 2%. Okay, 2% as an inflation rate. If we stay at our current trajectory that we've now been seeing for the past month and a half here in the Phoenix area, with supply, demand, balanced market, appreciation rates slowing, going down, etc., we will see balance, or I shouldn't say balance, we'll see that 2% rate achieved by March of 2023. Okay. At that point, then we'll see what happens. Because a lot of times the Fed typically overcorrects, right? We've heard about this. They're probably a little too slow to raise rates, let's be honest, and they're probably going to raise them too high before they turn them around, right? Why? Well, because housing is a slow-moving animal. Food, clothing, you can see a tick like that when you raise rates and people stop purchasing things, or it may be, you can see what happens right away with commodities and things of that nature. Housing market, it's like the Titanic, right? It just takes a while to turn. And if you're not sometimes educated, if you're not guessing right, let's put it that way, to an extent, then you might overcorrect. And that's what probably will happen here, is what most economists are thinking, but we'll see. It's a fun time, guys. Point is, if you're looking to buy, okay, it's still a time. It depends on how you look at it. If you want the leverage to dictate terms and hopefully get the seller to buy your rate down for you, you can't get a better time than right now, guys. Downside, obviously, is that if you wanted the rent, it could be cheaper. Now, but you got to run the numbers, which, you know what? Let's do that real quick. Let's do that real quick, because that's what I haven't done yet. Let's run the numbers before we wrap up here. Let's go back to our little AM calculator here. That same deal, you put 20% down with a $444,000 loan. What if, so we're at $2,953. What if you did a 2-1 buy down, paid for by the seller, 5% rate, year one? $2,383. That went down about, what is that, about $600? $600 a month, guys, for a 2-1 buy down. Now, what if you got really weird and you did a 3-2-1 buy down, right? You got the seller to pay for it. I don't know what that would cost you to check your lender because it's different in every scenario, but it's not going to be cheap. But let's say it was. I mean, why not? 4% rate. Calculate. 21.19, guys. That is, we're at what, 29 and a half approximately with a 7% rate, guys. That's approximately, I'm bad at math, $850 cheaper a month. Now you throw in some insurance and some taxes, throw another $300 onto this in that ballpark, maybe 350, and you're looking at 24 and a half, maybe $2,500 a month. Okay, now you're a lot more in line with this 2150 mark that is right at 2125 marks right there. Okay, so now it makes it a lot more palatable to purchase a property, and when you take your write-offs, you can possibly get from your interest write-offs and things of that nature, and all the benefits you get from home ownership from a tax standpoint. Maybe, guys, it makes sense, right? So I hope that helped. If we can help you guys in any way possible, please comment below. Please reach us you can always give us a call at 480-660-5974. That's 480-660-5974, or email us at info@cookandassociatesaz.com. Thanks, guys, for everything. We really appreciate you, and we look forward to seeing you guys next week on our YouTube Live, Everything Phoenix. See you guys.